We're joined by Nick Maroutsos. He's the co-founder and managing director of Kapstream Capital, which oversees about $4 billion. Nick, good morning. Thank you very much for joining us today.
Thank you for having me.
Nick, does the prospect of an Hollande presidency in France, does it make you more willing to buy French debt or less willing to buy French debt?
To be perfectly honest, I think everything that's happening in Europe is making us less willing to buy everything in Europe. The situation in France is a difficult one, and look, I'm not a political expert, but I can give you a view of what the market is actually thinking is that markets want stabilization. They like consistency. They don't like surprises. And the situation in France, while they may be undergoing a political change, we view it more as the devil you know versus the devil that you don't know, in the sense that new leadership means new change, new programs that may take place, which is certainly going to affect market participants' psyche as well as their investment profile going forward.
But Nick, Hollande, despite all his pledges to implement various reforms, he doesn't have much room to maneuver on the fiscal side, does he?
He really doesn't. And I think what people are more concerned about is that there seems to be a lack of transparency that's going along with his policies. So the fact that he can't necessarily move much on the fiscal side is probably a larger answer for the ECB, in the sense that more policy measures need to be put in place in order to help the situation. But people are tired of austerity measures. They're tired of the situation that's happening, and they want change. And personally, I don't necessarily blame them. However, I'm not sure if this is the path that we need to go down. And it also leads to the fact that what's being overshadowed by the French elections is the situation in Greece.
Yeah.
And I think that's far more important and poses even greater risks to not only to the European situation, but also markets in general. Because if you have a situation where if a radical group or radical coalition somehow wins, we could be pushed back to the point that we were in November, where it was questionable whether or not Greece was going to remain in the euro, and you could have Spanish yields and Italian yields being pushed back to the danger zone.
Yeah, I mean, Nick, as you were saying, the calls from Hollande and from others have been for the ECB to do more, but those calls have been, well, they're on deaf ears right now, aren't they? Because the ECB yesterday Draghi said that he didn't even discuss cutting interest rates, and that pushed the euro higher. Were you surprised that it didn't even enter into talks?
Yeah, absolutely. We were not surprised that they didn't cut interest rates. I think that is going to be something that's going to come later on. What we were surprised with the fact that they can actually, tell the market that their indicators are showing that the economic environment is relatively stable. Now, I'm not sure what sort of economic data points they're looking at, but the stuff that we're looking at shows that you have a demand for credit that's deteriorating. You have a French and German relationship that's becoming more and more adversarial. You have Spain, which is on, basically on a cliff. You have their stock markets that are essentially in a free fall. Until Europe stops operating as 17 independent countries and starts acting like one united front, I think the problems are still going to persist. There needs to be large-scale implementation and large-scale measures that are put in place, be it another round of the LTRO or other measures that can actually give the market a bit more stability.
Nick, let's start with the US. Is today's jobs report going to push us in the direction of, yes, this economy is on a sustainable recovery, or is it going to tell us things are slowing down?
I think that's the big million-dollar question, and unfortunately, payrolls has typically been a roll of the dice, in the sense that data numbers are generally relatively sporadic in terms of what is actually printed. But investors are looking for answers, and those answers really stem from how the global economy is, or actually the U.S. economy is performing. Are we on a sustainable path to recovery, or is this mixed data, this poor data that we've been receiving over the past week and the past month, an indication that the slowdown is here to stay? I think the problem that we're facing from an investment standpoint is that a larger than expected payrolls number will lead to risk assets performing well and bond markets selling off. But you could have a situation where you get a very low number and you get the same sort of effect, because investors will say, okay, now that means that the Fed's going to step in and QE3 is a likely probability.
And in that environment, environment, Nick, because of those eventualities which possibly might lead to the same thing, what does that mean on our perception, for our perception of the US bond market? I mean, do you buy US debt right now?
You know, it's a tough call. It's hard to look at the bond market optically and say, you know, I'm buying a 10-year bond at sub 2%. You know, I personally just can't bring myself to do that. I understand the investment implications, because people are saying, look, I'd rather get 1 or 2% on my bond investments and not have to worry about what is actually going to happen with my equity investment. The problem with the equity market is you have a lot of money that's sitting on the sidelines, and people have this pervasive fear that the next shoe is going to drop. So they're very worried about what's yet to come. So for many people, I think you know, a 2% yield is somewhat comforting. If we do get a stronger than expected payroll numbers, or if yields do sell off maybe 10, 15 basis points over the course of, let's say, a day or a week, I think it will be met with buying, because the larger picture still exists in that Europe is still a problem, and the growth is actually going to be somewhat slow to get us out of this recovery in the US.
Literally in 10 seconds, which debt, which country's debt should we be buying now?
I think you have to look to Asia, and I think we've said this before, and it's because we're firm believers in the fact that Asia's on the path to recovery. They're doing quite well. Yields are relatively high, and investors are getting paid a good amount of yield for taking a little amount of risk.
Nick, thanks a lot. Speak to you soon. Nick Maroutsos there, co-founder and MD of Kapstream Capital. Thanks for joining us today.